Hi, my name is Lucas and welcome to Adjusting Journal Entries in Accounting. We are firstly going to go through theory, definitions and worked examples within this presentation. My first definition is adjusting journal entries themselves. They are made to the general journal to record revenues that have been earned but not recorded and expenses that have been incurred but not recorded. There are four expenses and revenues that we use in adjusting journal entries. The first one is deferred revenue, which is receiving revenue before providing the service. We have accrued revenue, which is performing service before receiving payment. We have deferred expense, which is payment before the expense is incurred, and accrued expense, payment after expense is incurred. For example, Sephora offers an 8-month subscription to beauty products for $800 upfront. In this scenario, we would debit $800 to cash and credit $800 to unearned revenue. Now, after 4 months, we want our financial statements, and only half of the service has been performed. Therefore, we would debit unearned revenue $400 and credit cash $400. Now, for accrued revenue. Let's suggest that another firm provides their services to Sephora for 2 months at $1,800 upfront. In this situation, accounts receivable is debited and service revenue is credited. Now, after 1 month, if they produce their financial statements, they've only performed half of the service. They again would only earn half the revenue, so we would debit service revenue $900 and credit accounts receivable $900. For deferred expense, let's say that Sephora pays $20,000 in prepaid rent for the year. Therefore, we would debit rent and credit cash $20,000. Now, let's say they prepare their financial statements 3 months after paying for their year's prepaid rent. That means they would have only used $5,000 of the $20,000 in prepaid rent during those 3 months. We would debit cash $5,000 and credit prepaid rent $5,000. Now for accrued expense. Let's say that Sephora pays 4 employees $4,000 total on Saturday for their weekly work. We would debit salaries expense and credit salaries payable, both $4,000. Let's say that at the end of the Saturday, they need to prepare the financial statements. We would have to debit salaries payable and credit salaries expense, both $4,000, because the employees have been paid in their entirety for their efforts. Thanks for listening, guys. I hope you learned something and you ace your accounting exam. If you liked that video, feel free to give us a thumbs up, a like, comment, and subscribe. And follow my channel for some amazing accounting videos because I love accounting.